Switzerland is broke. Sure, this country has a reputation for wealth, stability, a sophisticated financial sector, and a high standard of living. The nation has long been in sync with prosperity, but that's not all the story. Beneath this exterior lies a complex economic landscape which could lead to Switzerland losing its strong economic position and becoming broke. Find it hard to believe? In this video, we'll be showing you the top 10 reasons why Switzerland is no more rich. Number 10. Global change. Recently, there has been rapid growth in the economies of countries. For example, China. While Switzerland has a respectable GDP growth rate, China's average growth between 2013 and 2023, 7.3%, dwarfs Switzerland's 2.2%. This rapid rise could see China surpass the US as the world's largest economy, impacting global dynamics. Additionally, emerging markets like India and Brazil are experiencing rapid industrialization and growth. The IMF projects India's GDP to become the world's third largest by 2028, highlighting the rise of new economic power centers. The landscape of trade is also shifting, creating both opportunities and challenges. Trade partnerships and regional blocs are increasingly shaping the global economic map. The European Union, a massive trading bloc accounting for over 16% of international trade in 2022, offers preferential trade deals to its members. While Switzerland isn't part of the EU, it relies heavily on European trade. A shift in focus within the EU could potentially impact Swiss exports. Emerging economies are also forming their trade partnerships, creating new economic corridors. The Association of Southeast Asian Nations, for example, boasts a combined GDP exceeding $3 trillion. This creates new investment and trade opportunities that might bypass traditional trade routes involving Switzerland. No trade means no money, and without money, Switzerland will be broke. Number 9. Innovation decline. A worrying trend has come up in Switzerland's traditionally strong innovation sector. Over the past few years, there's been a decline in both the number of companies actively engaged in research and development, R&D, and those successfully launching product and process innovations. This drop has pushed Switzerland from its previous top ranking in European innovation down to the middle of the pack. However, there's one bright spot. Switzerland's R&D expenditure as a percentage of company turnover has actually risen. This suggests continued investment, but perhaps a disconnect between spending and tangible innovation outcomes. Number 8. Increased cost of living. Switzerland's high cost of living presents a double-edged sword. Businesses face increased operating costs across the board, from office space and salaries to raw materials and transportation. These expenses can eat into profits and make Switzerland a less competitive location compared to countries with lower living expenses. For highly skilled workers, the allure of a good standard of living can be dampened by the high cost of housing, food, and other necessities. This can make it difficult to afford living and working in Switzerland, especially if salaries aren't adjusted for the cost of living, potentially leading to talent shortages in key industries. Even for well-paid workers, the high cost of living can translate to reduced disposable income, making Switzerland a less attractive option for those who prioritize a good work-life balance and the ability to save money. Number 7. Exchange rate imbalance. Fluctuating exchange rates can be a tightrope walk for Switzerland. A strong Swiss franc can make Swiss exports more expensive for foreign buyers, squeezing profits and hurting businesses, especially against competitors with weaker currencies. This can lead to declining export revenue and potentially even job losses in export-reliant industries. The tourism industry can also suffer as a strong CHF, which makes Switzerland a relatively expensive travel destination, reducing tourist inflows and impacting revenue from tourism. Furthermore, if the CHF weakens compared to major trading partners' currencies, the cost of imported goods rises. This can lead to inflation in Switzerland, eroding purchasing power and potentially impacting consumer spending. The challenge for Switzerland is that the Swiss National Bank, SNB, which has a history of intervening in currency markets to weaken the CHF when it gets too strong, faces limitations. These interventions can be expensive and have unintended consequences. In recent years, the SNB has scaled back its interventions, leaving Switzerland more exposed to the potential negative effects of a strong CHF. Number 6. Social programs. Switzerland's social safety net is a double-edged sword. While its generous programs offering comprehensive healthcare, unemployment benefits, and pensions contribute to the country's high quality of life, there are concerns about their long-term sustainability. A growing aging population means a smaller workforce supporting a larger number of retirees, potentially straining social security and pension systems. The burden doesn't stop there. Medical advancements and an aging population contribute to rising healthcare costs globally, and Switzerland's excellent system might face challenges as expenses continue to climb. Additionally, funding these programs often requires high taxes on businesses and individuals, potentially stifling economic growth by reducing disposable income and discouraging investment. Some even argue that overly generous benefits can create a disincentive to work, especially for lower-wage earners. If social programs provide a comfortable standard of living, some individuals might choose not to work full-time, impacting the labor force and economic output. These are significant challenges that Switzerland must grapple with to ensure its social safety net remains a source of strength and not a future burden. Number 5. The aging population. Switzerland faces a big demographic challenge. By 2045, the percentage of people over 65 is projected to reach 23.2%, significantly higher than the current 18.8%. This aging population has the potential to strain the social safety net and limit future economic growth in two key ways. First, a shrinking workforce will have to support a larger number of retirees. This can lead to labor shortages, especially in skilled professions. A 2023 study projects a potential shortfall of up to 1 million skilled workers by 2030 if current trends continue. This shortage could stifle innovation and economic growth across various sectors. Second, with more retirees and potentially fewer workers, the burden of funding Social Security and pensions will increase. This could necessitate benefit cuts, tax hikes, or both. Striking a balance between supporting retirees and maintaining a healthy economy will be a crucial challenge for Switzerland in the coming decades. Number 4. Global concerns. Even the wealthiest nations aren't immune to global challenges. Climate change and resource scarcity pose significant threats to Switzerland's future. The country's natural beauty and winter sports industry, a major draw for tourism, are particularly vulnerable to climate change. Rising temperatures and changing weather patterns could disrupt everything from snowfall to water availability. A 2022 report by the Intergovernmental Panel on Climate Change, or IPCC, predicts an increase in extreme weather events like heat waves and droughts across Europe, potentially impacting Swiss agriculture and infrastructure. Number 3. Over-reliance on specific sectors. Switzerland has a great reliance on imported resources, especially fossil fuels. As global resource scarcity becomes a growing issue, the cost and security of these resources could be negatively impacted. Switzerland's strength in specific high-value sectors like pharmaceuticals and financial services can be a double-edged sword. While it fuels current prosperity, over-reliance on these resources can be risky if the industries undergo significant changes. The rapid pace of technological advancement could disrupt traditional industries, potentially impacting Switzerland's core sectors. For instance, the rise of automation and artificial intelligence could threaten jobs in certain sectors of the financial services industry. Consumer preferences and global economic trends are constantly evolving. If Switzerland fails to adapt and diversify its economy beyond its current niches, it could face economic stagnation or decline. Without a broader financial base, the country might struggle if consumer demand for its niche products or services wanes. Number 2. Neutrality issues. Switzerland's historic neutrality has been a cornerstone of its national identity and a key factor in its economic success. It has allowed Switzerland to act as a neutral mediator in international conflicts and a haven for financial assets. However, recent global events raise questions about whether this neutrality can be maintained. The challenges are building up. Switzerland has traditionally avoided imposing sanctions on other countries, even during international conflicts. However, with recent events like the war in Ukraine, remaining neutral on sanctions has become difficult. Taking sides could damage relationships with some countries, while not taking sides could be seen as tacit approval of aggression. The pressure to choose sides in global conflicts can be immense, and economic and political pressure from powerful nations can make it difficult for Switzerland to maintain a truly neutral stance. Further complicating the issue is the shifting global landscape. The rise of new power blocks and the increasing interconnectedness of the world could make traditional notions of neutrality less relevant. Global issues like climate change and pandemics require international cooperation, which may not always be compatible with strict neutrality. Due to this, Switzerland risks losing the trust of some countries and its reputation as a neutral actor. This could erode its diplomatic influence and lead to economic repercussions, such as a decrease in foreign investment or a decline in the use of Swiss banks. Number 1. Extreme wealth. This seems odd, but you'll soon see why extreme wealth is making Switzerland poor. Extreme wealth, while seemingly desirable, can present a country with a unique set of challenges. The very factors that contribute to a nation's success can turn into hurdles as prosperity reaches exceptional heights. One hidden cost is brain drain. Highly skilled individuals may be lured away by even more lucrative opportunities abroad. Imagine a country with a booming tech industry. While it initially attracts the best minds in the field, if these talented individuals are constantly bombarded with offers of higher salaries or more prestigious positions elsewhere, they may be tempted to leave. This exodus of talent could then stifle further growth in the tech sector, hindering innovation and economic advancement. Another challenge is the difficulty of attracting new industries. Extremely high wages and a comfortable standard of living can make a country a less attractive proposition for new businesses. Companies might be hesitant to locate in a place where labor costs are significantly higher compared to other options. This can limit the diversification of the economy and make it overly reliant on existing sectors. For instance, a country known for its luxury goods production might struggle to attract companies in other sectors, like manufacturing, due to the high cost of labor. Furthermore, extreme wealth can sometimes breed complacency. When a country is already very successful, there might be less pressure to innovate and develop new technologies or industries. This can lead to stagnation and hinder long-term growth. Imagine a country that has built its wealth on a specific natural resource. If it fails to invest in research and development of alternative industries or technologies, it may struggle to adapt if the demand for that resource eventually declines. Finally, extreme wealth can promote social inequality. The gap between the rich and the poor can widen in countries with immense wealth. This can lead to social unrest and instability. As a wealthy nation becomes even more affluent, the benefits might not be equally distributed. This can create a situation where a small segment of the population enjoys immense wealth, while a larger portion struggles to make ends meet. Switzerland is rich, but as you have seen in this video, its wealth is the reason that it'll be poor. Will Switzerland manage to turn it around? Or will it slowly sink into depression? Let us know what you think in the comments. Don't forget to like this video and subscribe to this channel for more.